Hello, everyone. Welcome to today's Process Alpha webinar here with the Sherpa Funds Technology team. Thanks, everyone, for joining us this afternoon if you're here in Asia, this morning if you're in Europe. I'm going to guess we probably don't have anyone joining us at this hour from the States this time. My name is Stephen Quimby. I'm in charge of sales and marketing here at Sherpa Funds Tech. I'm joined by our founder and CEO, Richard Waddington. Richard, give the people a hello.
Hello, good afternoon, everybody.
Okay, well, so today we're going to be talking about ESG and active equity portfolio construction. And so this is a topic that I think is somewhat timely because ESG is obviously something that's been in the news quite a bit recently, especially with the recent conference in Glasgow and some of the new mandates that are coming down the line in terms of European disclosure requirements. And this is something that here at Sherpa Funds Tech, we find we are having to interface with a lot more than we used to with client fund managers. So we thought we would share some of our experience with what we see and some tips about how you can help integrate ESG into your traditional fundamental equity process. So today, if this is your first Sherpa webinar, we're trying generally to be around 30 minutes. We'll take questions at the end, but certainly if you have any questions midstream, by all means, feel free to put them in the webinar chat and we'll try to get to them as we get to them. If you have to jump for whatever reason, the full session will be online on our YouTube page later today. And if you'd like to have any of the slides or any of the materials from the webinar, email information will be at the end and just reach out and get in touch. So briefly, what we're going to talk about today, we'll kind of crash course through the introduction here. We'll talk about defining where ESG fits in your investment process, because this is something that in our experience, a lot of fund managers, especially fund managers from a fundamental background who are getting into ESG, are a little bit fuzzy on. We'll talk about some of the common considerations that we run into in terms of ESG in a portfolio construction context. We'll talk about how this sort of ESG as an objective or a constraint or a mandate requirement in portfolio construction, how you have to balance ESG with expressing your fundamental alpha to build the best portfolio. And then we'll dive into how you actually quantify what that means in practice. And again, we'll take questions at the end. So this is a topic that obviously is very important for most fund managers in the active equity space. As I said, this is a growing industry. It's been booming over the last number of years. And from funds that we talk with, there's not a fund manager I work with in Europe who doesn't have ESG front of their brain. They're not involved in sourcing ESG data and building ESG products and putting ESG overlays on products they already produce. And so this is an industry trend that I don't think is going to be going away. And if you're a fundamental manager in the US or in Asia, maybe you haven't come kind of full force into this in the same magnitude that people in Europe, where sort of the institutions are driving that change and the regulatory requirements are much different. But this is something that's probably going to be coming to you very soon. Now, with all that said, one of the reasons we think this is an important topic is because there's very little standardization in what a sustainability or ESG fund means. And as a result, most fund managers get by with being very fuzzy in how ESG works in their process. And so the real question that we put to fund managers when they say that they have an ESG component to what they do is, can you explain it? How exactly does ESG fit into your process? Is it a part of your alpha generation? Do you view ESG data, your ESG views as a source of alpha? Or is it a requirement that's being put on you by your investors? Is it something that, you have to build a portfolio with a particular set of ESG characteristics? And if you don't know exactly where the different sort of ESG pieces of your process fit onto that spectrum, it's going to be really difficult to make good ESG driven decisions, and it's going to be really difficult to make good portfolio construction decisions. So today we're not going to talk about ESG data. We're not going to talk about the quality and types. Without going into the details, this is something that I would say every fund manager we work with uses different ESG data in a different way. And so it's a huge space. There are more providers coming on all the time. The data requirements are changing. The disclosure requirements are changing. And this is something that, while I think we could talk about, we could spend an entire webinar just talking about ESG data. It's not something we're going to cover today. We're talking specifically about, and this is sort of consistent to what we do here at Sherpa, we're talking about ESG in terms of your process, and then quantifying what the impact of that process change or that process decision actually is to your final portfolio results. So
I would say, Stephen, it's important just for everybody to, if you are running money and you are concerned that you don't have a standardized data set, you mustn't think that you're alone. Nobody in our experience has got this yet. And so that's why we don't want to talk about it, because we don't have a solution. But it's not like you're an outlier if you don't have a standardized solution to this yet.
That's right. And I guess without going down that rabbit hole, I talked to one of the major ESG data providers that had raised a significant block of capital that didn't go predominantly into sales, didn't go predominantly into technology. It went into data sourcing and data scrubbing, because it's an incomplete data set for everyone everywhere, and it is changing really quickly. So one of the topics that we covered in one of our last webinars, when we were talking about sort of candidate portfolios, the portfolios that you can build, is a very top level overview, thinking about your investment process as defined by what assets can you invest in, how do you select from that universe of possible assets, and then what are the requirements of the portfolio that you have to build from those assets. And if we think about this is, I think, a fairly useful construction for relating how ESG can fit into different parts of your process. And again, different fund managers are going to, they might have only exclusion requirements that are only within their asset universe. They might take a purely sort of holistic view of how they assess ESG risk in a company, or sort of the developing ESG trends in the asset selection. They might have purely a constraint, it's maybe a passive product where they've generated something that has sort of a quantitative ESG tilt. Now, any of these are valid, and some fund managers might have all ideas at all three levels, but it's important really to figure out which of these your ESG concerns or your ESG decisions fit into. So this ties in, we want to kind of highlight this as a critical point. When you're thinking about where ESG fits into your fund, it's important to think about whether this is a source of alpha for your fund, whether this is something that is additive to the alpha that you're already generating in your fundamental research process, or whether ESG is predominantly something that's being brought in as a requirement from your investors as a part of your mandate. And if ESG is something that is an alpha generating part of the process versus ESG is a mandate driven part of the process, there are very different implications for the things that you need to quantify, the things that you need to test, and the things that ultimately you need to well understand. So if we're thinking at the first level, right, ESG in terms of universe definition, this is, I would say, probably the area that is the first layer most people think of in terms of how people integrate sustainability. And more often than not, what that means is exclusion filters. That means no sin stocks, no gun stocks, no tobacco stocks. That might mean, you want to exclude companies that have been in the news for particularly bad data breaches. It might mean that you don't want all male boards. It might mean that it's an ESG ratings exclusion, but though in practice, I don't think we actually have seen one of these. More often than not, it's characteristics of the company rather than necessarily an ESG data-driven discussion. But again, by and large, ESG in universe definition is fairly straightforward. What are you not allowed to invest in and why? Now, when it comes to asset selection, it starts to get substantially more complicated because there's a wide number of ways we see ESG being implemented in terms of the asset selection process. So some investors are putting in filters where they want to take best in class, or they want to take ESG improvers. Say they divide their universe into the kind of bulk middle of 50 to 70% of the names that have sort of standard ESG characteristics. Then they have 10 to 15% that are best in class, and 10 to 15% that are those that they see great improvement in. That could be a proactive filter on how they think about ESG. It also could be thematic investing, where the ESG comes in terms of thinking about sustainability themes. So obviously, these are the ETFs that you see raising huge amounts of capital. And you'll see the same thing in terms of some of the really big active thematic funds. There's a number of big houses in Europe that have had great success and have raised billions of dollars for funds investing in specific sustainability focused themes. For other managers, ESG is another part of the fundamental process. Maybe it's a way that they condition risk. Maybe it's a downside set of scenarios. Maybe it's a way they change or modify or increase their discount rate. And then last but not least, there's sort of my least favorite of them all, which is when you talk to managers and they sort of say that they take the whole ESG picture of a company into account when they do their traditional fundamental analysis. And this is what we mean when we talk about fuzzy. All of these are very different in practice. Filtering for the best ESG names, choosing a theme and finding the stocks around it, integrating ESG risk into modeling companies that you're following that don't otherwise have ESG characteristics. All of these are very different approaches. And if you're not clear about how these different things work, you're probably not going to be clear about how you would measure the impact of that set of decisions. So when we think about that, again, ESG in the asset selection, you want to be specific about what you're doing so that you can measure the impact on it, so that you can be more informed as you're making portfolio construction and investing decisions. And unfortunately, ESG in the asset selection is an area where it tends to be more subjective, and we tend to see it as more of a fuzzy piece of information, a fuzzy piece of knowledge. Now, if we shift and think about ESG at the portfolio construction level, what we usually talk about here at Sherpa, if ESG is a part of your mandate, that's not subjective. If your investors say that your fund has to have, less than 10% of the weight of the fund in energy complex companies, that's very cut and dry. And so while ESG in the asset selection process, a lot of investors can get away with it being quite fuzzy, as ESG enters the picture in terms of objectives and constraints, in terms of your mandate, it becomes much more concrete. Now, when you have this sort of concrete, absolute set of requirements, there's no, let's call it, and Richard talks about this frequently, there's no credit rating in the ESG space. So there's no standardized set of ESG metrics where every investor is looking for a fund that meets this particular type of ESG characteristics. In practice, there are many different ESG related data points or many different ESG characteristics investors might want their portfolio to possess. Now, in practice, some of those that I've talked to investors about, I have one fund manager who has a mandate where they have to see carbon emissions on a downward trend in the portfolio over the course of the next 5 years. And that's an SMA that they've set up for a very specific account. There's another where it's a fund where they have an internal ESG rating that they market, and as part of their mandate, their ESG rating on their long stocks has to be greater than their ESG rating on their short stocks. Essentially, they have to have a positive ESG bias within their fundamental alpha. Now, this is just scratching the surface, but there's a large number of different ways that you might integrate or that investors might ask you, what are the characteristics, the sustainable characteristics or ESG characteristics of your fund?
But the overriding thing, of course, Stephen, is that if you're going to have a process like this where you have a sort of investor-led requirement to do something, then you do have to institute some form of number, some sort of metric in your process, attaching a number to an asset. And again, that's not easy, but you have to do it. Once you've done that, you can then clearly show people we're using those numbers in a process to comply with the constraints or the objectives of the mandate. So numbers first, then process, and then you can show it.
Right, and that's exactly, when we think about whether it's fuzzy or whether it's sort of a more concrete thing, if you don't have numbers, if you don't have characteristics, you don't have anything really. And no one has a mandate for, we want ESG ... with no specificity to it. So a few things that we see, like I said, we've seen managers that look to maximize exposure to a particular ESG rating, maximize exposure to ESG scores for the full portfolio. Again, I talked about sort of the long short example. We've seen managers bucket ESG names into different types of categories, different characteristics, and then have requirements around how much weight or how much exposure they have to have for each category. Again, that could be in their mandate. We've seen thresholds set where they have to have minimums or maximums based on individual categories within a particular environmental, social, or governance vertical. We've seen changes in ESG as a requirement over time. And so this, I think, is just a sampling to give an idea that as a fundamental investor, you need to communicate with your investors about what they want, and then you need to bring ESG into the process in a objective, sort of concrete, explicit way to deliver that product that they want to pay for.
And certainly to deliver the message that you are delivering the product.
Right.
It's a key thing, right? You've got the message you are delivering, and you can show some process by which you are doing it.
That's right. And so when we think about that, if you start to bring in these requirements, the first question I would have as a fundamental manager is this ESG set of requirements dampening my alpha? Is this cutting into the value that I can deliver my investors normally? And if so, how much? And so this is something that we've never talked to an ESG investor who can put a concrete number on this. And maybe the investor has a view that over the long term, they expect this particular set of characteristics to outperform. And so maybe it's not a value statement, maybe it's not a stakeholder statement. Maybe the investor has a view that there is long-term alpha in having a particular sort of ESG characteristic that differs from what you traditionally do in your fundamental stock selection process. And so in practice, you need to have a way to think through how do these ESG requirements, how do ESG objectives and constraints interact with my alpha, interact with the way that I choose stocks and what that means in practice for my portfolio's performance. So if you add, very simply, if you're adding ESG, what does it do? How do you measure the impact? How do you quantify that impact so that you can make a more informed decision? Now, this is something that obviously at Sherpa we spend a lot of time thinking about, and it's something that we've spent a lot of time devising tools and techniques to try to quantify the impact of particular constraints or particular decisions or particular signal integration. And so,
this is not just about ESG, right? There's any one of thousands of different possible constraints you can add onto your process will impact the end result. Assessing the quantity or the difference in returns or difference in risk that this will do ex ante is really important, so you know whether you've made a right call. So we are talking about ESG through this lens, but actually you can talk about pretty much anything else as well. Changing the number of portfolio managers, or changing the liquidity constraints, or changing the investable universe.
Right. That absolutely. And so this is something, when we talk about this, usually the tool we use is what we call a candidate portfolio analysis, which if you haven't joined us for any of our previous webinars where we've talked about this tool, how it works, how we integrate it at the 10,000 foot level, what this means is taking a set of stock picks, a set of asset selections, and a set of objectives and constraints, and then building a very large sample set of possible portfolios you could build from those assets consistent with those objectives and constraints. And so if we talk about this in terms of ESG, obviously ESG in this context is just one more requirement in the context of what the shape of the portfolio has to look like. And so this is a framework that, without going into detail, again, if you want to look for more information, visit our YouTube channel, visit our website, on our blog, we have different information. But the candidate portfolios is a way to visualize the portfolios that you could build from a set of assets, subject to a set of objectives and constraints, so that you can test the sensitivity, so that you can test and really visualize and quantify what changes to either the objectives and constraints or the set of assets mean to the set of possible results. So the live example we're going to look at today, this is a real global stock fund. It's around 50 stocks. It's run by a traditional active fund management house. This manager, as they sort of integrated more and more ESG data, they had more and more requirements from their clients to produce ESG flavored versions of their existing products. And so this set of data is integrating a set of ESG constraints on top of what the fundamental manager was already doing. So they already had a public, global, traditional version of this active fundamental fund, and they integrated this ESG concept where they had a specific mandate from a specific client, and they needed to know what expectation should they have of how the ESG mandate was going to change the resulting portfolios from their core fund. And so that's where we come in today, talking about quantifying this difference so that they, as a management team, as the fund manager, know what the expectation should be, and so that they can communicate and make sure that all of that is consistent with the client's desires in a way that's going to help them grow this mandate. So, Richard, walk us through what are we looking at?
All right. So, and again, for those who have seen these before, you'll be familiar with the candidate portfolio graph. The first thing, when you see this graph, a lot of times people think it's a simulation of the market. It's not. It's the period from whatever it was, March this year through to just a couple of weeks ago, so the last 6 months really, of how the market in these 50 odd assets actually happened. And each line, each little green line, represents one possible construction, one possible portfolio that this manager could have built out of their selection of the 50 assets. So they have a universe, I can't remember their benchmark, but they have a universe of 2,000 assets. They pick 50. They have some general constraints, the sum of the 50 have to add up to 100, so there's no leverage, there's no cash, and nothing can be more than whatever it was, 6%, and etc. But each line represents one possible way of taking the 50 assets that they have chosen and building a portfolio that is compliant with a sort of global set of simple constraints. And then you walk forward in time and you say, actually, okay, and this is benchmark relative, this picture. You say, okay, what is the spread of possible outcomes you can have had, or you have actually had? And so you can see that, the 50th percentile is pretty good at 10.9%, nearly 11%. But you go from 8 and a bit to nearly 15% on a real outlier on the upside. So the point here is that there is a lot of alpha in the asset selection. We can see that. There is about 6 or 7% of possible variation in your experience, depending on how you built your portfolio out of the same 50 stocks. Now, you pick the same stocks, you get quite a broad possible range of experience. Now, in reality, these guys, like many people who run money, have particular institutional levels. This is not at the wealth space, but at institutional level, they will have benchmark relative constraints. So they cannot be more than a certain differential to the benchmark in sector or country or market cap. And these guys had relatively strict sets of constraints across 2 or 3 different dimensions. And so when you say, okay, that then reduces the total possible set of portfolios you could construct, you get, of course, a narrower possible outcome. And you can see that the band, the blue lines are I think the 10th and 90th percentile.
That's right, yep.
10th and 90th, yeah. Percentile of possible breadth. The blue lines have come in, and of course, more interestingly, because you've constrained your outcome, you've also actually slightly negatively impacted your median alpha. So your actual possible return has reduced. Now, this is before the ESG. Now, as Stephen said, these guys, in this next line, these guys were asked to create an SMA, and these guys are very serious, large managers, to create an SMA for a big institutional client, which had, in addition to those other constraints, had a ESG constraint. Now, exactly how the ESG loadings are calculated and applied doesn't really matter here. The point is that this further reduces the possible set of portfolios, and you can see you end up with a narrower band again, a slightly more constrained band, and a lower median return, right? So by doing this analysis, and this analysis is particular to this fund manager with these processes and this set of constraints, but by doing this analysis, we can see, if we summarize, we can see that, I don't know if you can see my cursor, that the median return of the alpha has gone from 10.9%. When it's constrained in its normal, sort of sensible constraints, it goes down to about 10.6 and a bit. And then adding the ESG reduces that further to 10.2 roughly. So you can say, actually, this ESG constraint, absent everything else, and without thinking about it in any kind of further depth, so without revising the way we pick stocks or revising the way that we manage our other constraints, has an impact of, it's saying there, whatever that is, 60 odd basis points, 60, 70 basis points. Now, is it exactly 70 basis points? No, of course not. But you with quite a lot of confidence, that this constraint has cost you somewhere between 50 and 100 basis points of return. As a manager, you can make your decision as to, does that make you marketable enough to attract more AUM, or are you more concerned about the return? I mean, these are the resource allocation decisions that you as a manager have to take, but you have to take them in an informed manner. Right? If you don't have the information, you're just sort of stabbing in the dark. So by performing this sort of analysis, you can sit down and say, actually, it is worth us giving up that 50 bips because it will increase our AUM by X, or increase our marketing or stickability.
And you can see here, it's actually quite unintuitive. And more so that if you could actually see the portfolio and the constraints, it's even a little bit more unintuitive than this would suggest, because there were quite a few constraints on sector and country and market cap. So there were more constraints numerically and more potentially binding constraints in terms of let's call it traditional constraints. The ESG constraint was relatively simple, but because of how the ESG constraint interacted with the manager's selection alpha, there is a much larger impact from the ESG constraint than from the normal constraints.
Exactly, and that would lead you as the manager to ask yourself, all right, what is it about our alpha, our asset selection process, which is leading us to actively penalize ourselves when we look at it through the ESG lens? And it could be that you have a brilliant tobacco and defense stock analyst and a terrible renewables analyst, right? I mean, it can be something along those lines, or it could be that you have a natural bias to, momentum industries from the 70s. But it shines a lens on something. It's saying, oh, actually, there's a significant non-independence between my alpha and the way that we score ESG. Now, the interesting how this actually interacts also is, how does that alter the possible range of outcomes, right? So we know that adding the ESG constraint has reduced our possible return, or our median return, but we also see that because it constrains the portfolios, what portfolios you could actually build from that set of assets, you end up with a narrower spread. So you are more sure of where you're going to end up. Now, is that good or bad? Well, it's bad if you think you've got an edge in portfolio construction, because you're going to miss out on the kind of top half of possible returns. It's good if your portfolio construction is not very scientific or very cleverly done, because you're going to be in a narrow spread.
Well, and this is really bad if your impact of your constraints on your alpha is really large.
Yeah.
If you are giving up 300 basis points because your constraints are very tight and your range is narrowing, you're most likely going to lock in that loss.
Yeah.
There's no room to catch it up for being good at portfolio construction.
Yeah. Yeah, if your portfolio construction doesn't give you back the edge, then that number is number. Now, what's actually quite counterintuitive, and it was certainly to me when we first ran these numbers. And Stephen and I go back and forth, and Stephen had to kind of drum into my head that I wasn't dreaming. Despite the ESG portfolio having a lower overall return, and despite the range of possible returns that the ESG portfolio could give you being narrower, the volatility of returns that you experience in the ESG portfolio is higher. Right? You can't really see that on the graphs because the lines, but when you look at the data, it's very clear that the vol, this is the average vol, but also you can see the median and the spread. The vol of the portfolios which have ESG constraint in them is higher than the vol of the portfolios that do not have the ESG constraint in them. And what's driving that is that the impact of the ESG constraint is actually to concentrate your risk in things that have ESG compliance. And whenever you rebalance your portfolio to concentrate, to increase the concentration, again, however you want to measure that, increase the concentration of your risk, you are inevitably going to end up with a higher ex post volatility metric. So adding this ESG constraint has lowered your median return and increased your volatility. And you've got a, you have a sort of metric, you have some sort of idea of how much this is. And from that, you can make decisions around, do we have to, as we said earlier, do we have to re-examine our alpha process? Do we have to look at what our priorities are? Where should we, what do we go out and hire a renewables analyst? Because we need more alpha that is ESG compliant.
And as we said before, this is something that, and our consistent feedback in looking at this type of data with clients is that they are surprised by the results because it's not consistently intuitive. And if we ran through results preparing for a webinar that were not intuitive and unexpected to Richard, who spends all day looking at portfolio construction data, if you are a traditional stock picker and you think that you have a good handle on the direction and magnitude of the changes of constraints on all of your potential portfolios, good luck. That's all I can say to you. And so it's a very important thing to know. It's an important thing to be able to quantify, an important thing to be able to integrate into your process, but it's something that you're unlikely, unless you do the hard work, to actually get right. And so, we're kind of running a little bit out of time, which is good because we've come to the kind of the end. The next step from this is actually using these constraints, using this data, using all of these pieces to build the best portfolio to actually express your traditional fundamental stock picking alpha or your ESG enhanced alpha, subject to the mandate requirements, subject to the constraints that your investors want in an increasingly ESG focused world. And so if you
and assess your own business as to are you doing things which are kind of conflicting with what you're really trying to achieve? Are the steps you're taking in ESG space impacting you in other spaces? And what can you do about it? And these aren't unsolvable problems, but unless you get a handle on the metrics of the size of the problem, you will struggle to find a way to solve them.
And so really the takeaway that we want to make sure everyone leaves this session with is that when it comes to thinking about how ESG fits into your process, into your investment process, you need to be explicit about what you are doing and how it fits, because only by being explicit can you quantify and measure the impact of what you're doing, and then you can make better decisions and improve it. If you can't measure it, you can't improve it. And so when it comes to ESG, you have to be explicit, quantify it, and improve it. And so if you want to learn how you can do these things, how you can quantify these, how you can use the candidate portfolio framework, if you want to learn how we can use Sherpa's process to actually put all of these pieces together and build the best portfolio to express your alpha, contact information is here. Get in touch. If you came in late and would like the slides, again, feel free to shoot over an email, or the replay will be online on our YouTube page. I think we've covered all of our ground and we've run a little bit on over time. I don't see a lot of questions, so I'm going to go ahead and assume that we've been hopefully fairly clear, but again, if you do have any questions, please let us know. So I'd like to thank everyone for joining us today. Richard, thanks so much for taking the time to share your thoughts with us today. Any last comments?
Just thank you very much from me, Stephen, as always, for organizing, setting up, and thanks everybody for hearing us.
Okay, great. Well, it's been a pleasure. So everyone look out for the replay online on our YouTube page and for our next Process Alpha webinar. We'll probably see you in the new year.
Thank you very much.